Concepts of national income. 1. Meaning of national income. National income is the income of a country. It is the aggregate of incomes earned by the individuals in a country. Since income is measured in terms of money, it is defined as the money measure of the overall flow of final goods and services in a country during a year. This includes the goods and services produced by the government. In addition, imports and exports also play a major role in determining the national income of a country. A healthy growth rate of national income is usually taken as an indicator of high level of economic activity. This implies people are able to earn larger incomes. This is said to be an indicator of better standard of living. There are a number of concepts relating to national income. The most important of them are 1. Gross National Product (GNP). This is of two types: A. GNP at market prices, and B. GNP at factor cost. 2. Net National Product. This is of two types: A. NNP at market prices, and B. NNP at factor cost. 3. Gross Domestic Product (GDP). This is of two types: A. GDP at market prices, B. GDP at factor cost. 4. Net Domestic Product (NDP). This is of two types: A. NDP at market price, and B. NDP at factor cost. Gross National Product (GNP). Gross National Product of a country is the aggregate value of all final goods and services produced in a country in a year. It is important to note that the definition includes only final goods. The value of all intermediate goods is excluded. GNP includes the following components: value of consumer goods and services C. C is called aggregate consumption. B. Value of capital goods I. I is called aggregate investment. C. Value of goods produced and services offered by the government G. G is also called government expenditure. Net receipts from abroad. Value of exports X minus imports M. Net income transfers from abroad. Payments received from other countries R minus payments made to other countries P. Taxes IT. The price of a good includes the manufacturing cost and indirect tax. Hence, to know the real cost or the factor cost, we must subtract taxes. Subsidies. Yes. Subsidy makes the price of a good different from the real cost. In a developing country like ours, to help the producers, the government provides incentives to the producers to purchase the factors of production at a price lower than the market price, if that is by subsidizing it. Using the above components, we define GNP at market price equal to C plus I plus G plus X minus M plus R minus P. GNP at factor cost C plus I plus G into X minus M plus R minus P minus IT plus S. Net National Product (NNP). In the process of production of goods, some of the capital equipment like machines and buildings get old and worn out, and therefore there is a loss in the value of capital assets. This fall in the value of capital is called depreciation. Depreciation is subtracted from income generated to get the true value of the national product. A. NNP at market prices equal to GNP at market price. B. NNP at factor cost equal to GNP at factor cost. Gross Domestic Product. The gross domestic product is different from the gross national product. GDP does not take into account the income that the country earns from abroad. Thus, as the name suggests, it is the domestic income that has been generated over the years that is calculated. Net Domestic Product (NDP). GNP at constant prices simply means that we calculate the value of gross national product by multiplying the quantities currently produced with the prices that prevailed at some previous period in the past. The period thus chosen is called a reference period or a base period.